You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Summer Properties Northwest, Reynolds and Klein Appraisal, and your host this episode of the Seattle Real Estate Podcast. We are getting away from our CHOP coverage. We're getting back to the nitty-gritty of business and real estate, because CHOP's over and there doesn't happen to be another uprising going on here in Seattle. So we're going to get back, not quite as exciting a topics, but I kind of give it my own spin. So hopefully you'll be entertained by some of that and appreciate the insight that I bring to this. So let's jump on in. And right now what we're going to do is we're going to look at why investors should steer clear of trading most stocks on Robinhood. Now, I think a lot of people have heard about Robinhood. It's an online trading platform that a ton of millennials have gravitated towards, and a ton of people during the pandemic, the COVID-19 shutdown, have gone to as a means of entertaining themselves and also doing some investing. But it's an online platform that's also taken some real heat. We're going to look at an article from the Motley Fool, but the first article that I think some people have heard about, anybody in business media has heard about. That's a 20-year-old Robinhood customer dies by suicide after seeing a $730,000 negative balance. And he was a Robinhood trader, and he was performing a bull put option, I think is what it was called. But in between his trades, he had about $16,000 in his account. And in between his trades, when he was closing out, there's basically this numerical, not error, but the way that they calculate it showed up that he had a $730,000 negative balance. And he thought, oh my gosh, my future is ruined. And so Robinhood trading has gotten kind of some bad press from this. Like, man, we're letting these young kids trade on here. What are you guys doing to make sure that people understand, the upside and the downside of trading on something like Robinhood if you don't really know what you're doing? And this poor kid, he basically said, I don't understand how they could have let me go so far deep. So if you are a young investor and you think you have something like this happen, maybe you're down $5,000 or $10,000, let another more experienced investor know what's going on, get their take on it, because so much of this stuff can be solved by having somebody with a little bit, doesn't necessarily have to be an adult, but somebody with more experience take a look at the issue and figure out if there's a workaround. Because in so many deals in real estate and so many deals in business, there's always a workaround from somebody who's got just a little bit more experience. So this poor kid did not need to kill himself, but he did because he thought his future was over. And from what I can tell, he's one of those super conscientious kids who was always saving at an early age. And for him, having this massive negative in his portfolio was so devastating that he took his own life. So, you're seeing some of that come out in the media as far as Robinhood goes. But I think bottom line is that people have to be responsible for their own decisions, whether it's trading or whatever else it is that you decide to do, go out and do. So why investors should steer clear of, in parentheses, most Robinhood stocks. So let's get into it. Some of the top stocks on Robinhood are also among the most volatile. Imagine that. Hey, this one's got a lot of activity on it. And people don't care whether it's going up or going down. As long as there's activity, you've got margin to make some money. So there's been a lot of volatility on the markets this year since the outbreak of COVID-19, a lot of which has come as a result of more investors getting involved in the markets. The pandemic is keeping people at home, and live sporting events have been canceled, meaning people have been buying and selling shares as a way to generate some excitement in their day-to-day lives. And one particular platform that's been attracting young investors is Robinhood. So I kind of poo-pooed the idea that people are taking their COVID bonus money, the federal money, and putting it into things like this. But I think it's a real deal. My oldest son, Kieran, he's 27. He has a pretty good-sized Robinhood portfolio, and he trades pretty actively. And he said, Dad, this is a total thing. You've got people from all over who don't know what else to do, and they've got some extra money, and there is a certain percentage of it who are putting their money into the market. Another way that I have kind of come across this is my buddy Dan Flitch, who I've had on the podcast multiple times, and he's a small business owner, and he's an owner of a couple of sporting bars Sports pub bar, sport pubs, sport pub and grill. I can't remember, whatever they're called. So he has pull tabs in one of his bars, and it has done exceptionally well since he's reopened in phase 2 in Washington. Like, people don't have an outlet for, like the article here says, a little bit of excitement in their day-to-day. So they're going to gamble on, what little money they do have on a possible outcome that maybe they make some good money. And I think a lot of people are looking at Robinhood, the online platform, the same way. Hey, I can do this from my phone. I don't have to take a ton of time. But there's a real downside to it as well. And so being a disciplined investor, and you got to figure out what you're doing, because you can get into some real trouble in this stuff. But let's take a look at some of the stocks that are being traded and why they are risky. The top stocks on Robinhood are some of the riskiest investments to hold. Retail investors, especially those on Robinhood, are often more willing than institutional investors to take on significant risk for the chance to rake in a significant profit. That's why people are doing this. Big risk, big gain. Simple as that. There's no better proof of that than what happened with Hertz. Now, I did a podcast on this, and I think I called it investing in zombie companies or something like that, because these are literally companies that are dead, but because of platforms like Robinhood, they're being kept alive as, kind of walking zombies in the Walking Dead style, because so much money is being pumped into them, even when they're in absolute bankruptcy. So despite filing for bankruptcy on May 22nd, Hertz, the stock was seeing a lot of activity on Robinhood. Data from RobinTrack, which tracks stocks that Robinhood users hold, shows that there were more than 170,000 users who were holding shares of Hertz on June 14th. Prior to the bankruptcy announcement, there were fewer than 44,000 Robinhood users who were holding Hertz stock. So it went up when they went into bankruptcy. Everybody's like, hey, this is volatile. Let's jump in on this. Kind of that herd mentality. Shares of Hertz would go from a low of 40 cents per share following the bankruptcy announcement to a high of $6.25. And that was on June 8th. The stock has since crashed back down to about $1.50. So big run up, big run down. It's not just bankrupt stocks that retail investors have been chasing. Among Robinhood's 100 most popular stocks are many of the riskiest stocks that you can hold. Big risk, big return. COVID-19 has crippled the airline industry to the point where even Warren Buffett dumped his holdings. Now, he was pretty famous for dumping his holdings early on, and he hasn't jumped in on this big run up in the stock market. He hasn't really been there. He's kind of doing some buying in right now as of July the 6th, but he has basically been absent from a lot of this super risky speculative trading, and people have said, hey, you're missing the boat. He's got so much money. I think he's like, hey, look at my boat. I didn't miss anything. American Airlines and Delta Airlines were both in the top 5 holdings as of July 1. Cruise lines have also been synonymous with risk, yet both Carnival Cruise Line and Norwegian Cruise Line are among the 15 most popular Robinhood stocks. Now, cruise lines just got murdered at the beginning of the coronavirus. You had boats that had people on them that were infected, that they weren't allowed to come into port. They're going to a bunch of different ports. Maybe they get let in like the country of Greece or some crazy thing. I mean, what a disaster that was. And then nobody knows when people are going to be comfortable going back on cruises, because it's basically a petri dish for the coronavirus to, you get all these people stuck in a boat and they're all breathing the same air. And it's just a recipe for disaster. So who knows when the cruise industry is going to get propped back up. But so many of them are internationally based that they didn't get a ton of funding from the U.S. government. All right. Cannabis stocks have been among the most volatile investments to hold during the past year. The Horizons Marijuana Life Sciences ETF is down 65% in the past 12 months and makes the Standard & Poor's returns of just 5% look incredible by comparison. And yet, pot stocks aren't hard to find on the Robinhood 100 list. Pot stocks, to me, are a no-go, and here's why. If you are owning a company that is illegal on the federal level, it is illegal. It might be legal in your state on the state level, but if it's illegal on the federal level, to me, that is a no-go as far as business goes. I draw the line there, and I am as 420 friendly as anybody. But as far as a business goes and not being able to use the U.S. banking system, not FDIC backed, I mean, that's pretty volatile. When the Fed can come in and shut down your business any given point in any given day, that to me always looks like a recipe for disaster. I'm probably wrong, but that's just my call. So stocks that aren't risky are often overpriced. Not every stock that's popular on Robinhood is a bad buy, but many of the ones that are good long-term buys are just downright expensive. As seen from Hertz's astronomical rise in price, hype can play a big factor in determining which stocks will be popular on Robinhood. For example, shares of both Amazon.com and Tesla are both among the top 20 most held stocks on Robinhood, and both are trading at their all-time highs. Avoiding popular Robinhood stocks may help keep your portfolio safe. Retail investors have driven a lot of volatility in the markets this year, and if you want to prevent your portfolio from going on a roller coaster ride, it's probably a good idea to generally avoid stocks that are among the most popular on Robinhood, especially those that rank in the top 20. It could be a sign that they may be about to experience a lot of volatility if they aren't already. Sticking to unpopular blue chip stocks is likely a much safer route to take. But again, you don't have that risk to return. You can't have something just run up, make a bunch of money, and you dip out. I mean, that's always the goal, isn't it? I know a lot of investors who use basically stop outs to, if it drops 5%, then I'm out, I'm done, automatically sell kind of thing. All right, one quality stock that isn't among the most popular list on Robinhood is Medtronic. Fewer than 12,000 Robinhood users are holding shares of the stock, despite paying a dividend yield of 2.5%. And so they go on to kind of recommend this stake, this company. The key takeaway from all this is that investors should avoid chasing stocks that are popular on Robinhood and instead do their own due diligence when deciding on which companies to invest in. Buying a stock because it's hot is an easy way to add a lot of volatility to your portfolio. And odds are that it isn't going to be a good strategy as the economy is in recession and the world is dealing with a pandemic, which could suggest that another market crash may not be too far away. Now is the time to exercise caution and stick with safe stocks like Medtronic that they're pitching here that could help get your portfolio through this adversity. Or you can do what old guys do, and you get a financial planner to figure out what your goals are, what you want to do, and you start creating a actual plan towards your financial future, towards your retirement. So long-term plan. None of this short-term stock selling stuff. I mean, it can be done and you can make some money, but if any of you out there remember the tech crash of 2001, everybody and their brother was day trading. That was the big thing. Is back then, computers were kind of really just coming around, and you could trade with, I want to say Les Schwab, but that's the tire place. Charles Schwab had some really good online applications. What's the other one? There was E-Trade. E-Trade was a big, huge platform. I think they got bought up and absorbed by somebody. But you go on there and execute your own trades. Before that, you had to call up your stockbroker and say, hey, Mr. Stockbroker, can you buy this? Can you sell it? And you were kind of at their mercy to execute your trades. But in the early 2000s, you could do it yourself. But then the tech market took an enormous bath in 2001. And so many people lost so much equity, especially in their retirement plans that were heavily invested in these tech stocks. So people got really burned there. So I kind of feel like with the way the stock market has run up, there's a lot of trading on these online platforms that's just as volatile as it was back in 2001. But we've got a new group of investors. They're younger investors. They're millennial. They don't have the history that us old guys do as far as what it's like to lose everything and have to rebuild. And after you've done that once or twice, you're not real excited to lay everything on the line and kind of do these big trades that are high risk return. So you put together a game plan and you figure out what it is that you want to do and you work towards accomplishing that. And maybe it's a slower ride. And that maybe some of that's what people are looking for here is they want this short, volatile ride. They want some excitement because when you're stuck inside your house and you've looked at every news story that's out there, what else do you have left? Maybe you're a really good trader and you're in on it. But with the number of people that have joined in on the Robinhood training platform, I got to say a lot of those people are just looking for some excitement, looking for the quick buck, and they won't be long-term investors. I think a certain percentage of them will probably get more into investing, like my son Kieran. He's been investing kind of slowly for the last few years. And he's another great example of somebody who should take a percentage of his portfolio and start funding his retirement now. Because when you're 27, you've got compound interest over time working in your benefit. And that, if you put a little bit of money in now and you just keep adding to that, over time, you'll have a big, big nest egg. And it's just time. It just takes time to get there. So that is about all I've got for the Robinhood, whether you should or shouldn't invest on Robinhood in general or some of its specific stocks. But keep in mind that there's nobody out there watching your back when you're trading on these online platforms. There's nobody over your shoulder going, don't do that one. It's all up to you. So if you screw up and lose all your money, you've got one person to blame, and that is yourself. So be safe out there. There's a ton of YouTube channels you can watch to get financial advice. And on that, just read between the lines of what people are trying to sell you, because even like this article here in the Motley Fool, they're pushing Medtronic. Do I think it's a good stock? I have no idea. But there's so much of that out there where people have a good article and then they push a certain stock because that's their agenda. So just be careful of what you're investing in and what it looks like. And if in doubt, reach out to some kind of professional and get some professional help if you can. All right. Again, I'm Sean Reynolds from Summit Properties Northwest, Reynolds & Klein Appraisal. And thank you so much for watching this episode of the Seattle Real Estate Podcast. If this is bringing value to you, love to have you hit the subscribe button. I know you can do it. All right. Thanks again for watching. I'll catch you in the next one. That's it for me right now. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.